Well, hello everyone. This is a recording for the homework for Chapter 12, ACG2071. Okay, let's go through some of the homeworks. I'm going to go through actually questions 2 through 7. And this chapter was all about decision making. And the main topic in this chapter, of course, is deciding what costs are relevant and what costs are irrelevant, and which revenues are relevant and which revenues are irrelevant. Once we can determine relevancy, we can then easily make our decisions. So here we have an example. We have a Regal Cycle Company. They manufacture 3 types of bicycles. They have a dirt bike, a mountain bike, and a racing bike. And you can see all the data for the sales, the revenue, as well as the expenses for all 3 divisions and the total for the company. Now the total for the company, we can see they actually make a net profit of $32,000. But when you actually take a look at the details of dirt bikes, mountain bikes, and racing bikes, on the face of it, it appears, and I'm circling it right here, it appears as if the racing bikes are losing money. So management is concerned about this $9,000. And of course, they want a recommendation whether the racing bike division should be dropped or it should be retained. So when we actually look at the details of the current, like we said, was $32,000, and the racing bikes, we're thinking it loses $9,000, but is that really true? Well, let's think about this. Would we lose the sales if we dropped the racing bike? Absolutely. Would we lose our variable overhead? Yeah, we would. We would lose $27,000 in contribution margin. Now, what about fixed expenses? Would we lose the traceable advertising? Yeah, that goes away since it's traceable directly to the racing bikes. If we don't have the racing bike division, that's going to go away. How about the depreciation on the special equipment? Would that go away if we simply drop the racing bike? The answer is no. We've bought the special equipment. It really doesn't have any saleable value because it was special for this individual division. So we still need to depreciate that equipment. That does not go away, that $8,000. Salaries of product line managers? Yeah, that'll go away. And how about the common fixed expenses? Nope, they are common expenses. They're just going to be reallocated somewhere else. So we don't lose the $12,000 and we don't lose the $8,000. So out of the 8 and the 12, how much is that? That's $20,000. That stays. So do we really lose $9,000 if we got rid of the racing bike? The answer is no. In actuality, we gain $11,000. The racing bike made $11,000 because these $20,000, that's not going to go away. And here's the analysis. So currently the company is making $32,000. Now, if we dropped the racing bike, as we said, we would lose the $27,000 in contribution margin for sure, but we'd only lose $16,000 of expenses. So if we lose $27,000 in contribution margin and $16,000 of expenses, we're giving up $11,000 net income. So in actuality, the net income for the company would decrease $11,000 if we got rid of the racing bike division. So should the production and sale of racing bikes be discontinued? The answer is no, absolutely not. This is the way we should present. And if we present it this way, there wouldn't have been a question to begin with whether we should get rid of the racing bike division. And the bottom line is this: do not allocate common fixed expenses. The common fixed expenses should remain only in the total column, not allocated to the individual divisions. And with that, we can clearly see each segment is making a positive margin. All right, so that is the better way to answer this question. All right, next question. We have a company, Troy Engines Limited. They manufacture a variety of engines for use in heavy equipment. The company has always produced all of the necessary parts for its engines, including all of the carburetors. An outside supplier has offered to sell one type of carburetor to Troy Engines for a cost of $35 per unit. To evaluate this offer, Troy Engines has gathered the following information related to its own cost of producing the carburetor internally. So they look at their own internal accounting data, and it looks like the total cost internally to make a carburetor is $42. And so obviously an unsophisticated manager would say, heck, we're making it ourselves for $42 and someone is offering to make it for us for $35. This is a no-brainer. We might as well go and ask this person to make it for us and we can save $7 a unit. Well, not so fast. Let's take a look at this. Well, out of the $42 detail, direct materials are $14, direct labor is $10, variable overhead is $3, the traceable fixed overhead is $6, and the allocated fixed overhead is $9. Okay, now we can see the traceable fixed overhead. There's a little asterisk here, and the asterisk says $2 of it is supervisory salaries, and $4 of it is special equipment with no resale value. So the question is, out of the $42, how much of this is relevant? Meaning, how much of the $42 would be eliminated if we did not, if we went and we bought it from somebody else? So let's take a look down here. Is the $14 relevant? Yeah, sure, because we'd have to buy it if we made it ourselves. But if we didn't buy it, we wouldn't have to pay for it. How about the labor? Yep, that's relevant. The variable overhead of $3. Yeah, that's relevant. And how about the traceable? You remember the traceable? It was $6, and we said $2 of it was salaries and $4 of it was depreciation of special equipment. Well, out of that $6, only $2 could have been eliminated if we didn't make it ourselves. So internally, the differential cost is not the full $42, only $29. The other expenses we would have to pay for, regardless of the decision. That means they're irrelevant for the decision-making process. How about buying it? Well, we said buying it $35 each. So when we actually take the dollar amounts times the number of units, we get our full dollar amount. So our internal costs, our internal relevant costs, I should say, to make it ourselves is $90,000 less than if we bought it from outside. So that gut reaction that we should buy it from somebody else instead of making it ourselves is definitely just that, a gut reaction, and it is the wrong decision. Once again, the bottom line, in order to answer these questions, the best way to do so is to only consider the costs that are different between the two alternatives. And in this case, only $29 of making ourselves is different. All right. All right, we have a jeweler here. They're considering a special order for 20 handcrafted gold bracelets to be given as gifts to members of a wedding party. The normal selling price of a gold bracelet is $189.95. And its unit product cost, which we still see here, materials, labor, and overhead, totaling $149. Most of the manufacturing overhead of 20 that we see here, most of it is fixed and unaffected by variations in how much jewelry is produced. So they're saying out of the 20, all of it is fixed except for $4 of it. $4 of it is variable with respect to the number of bracelets produced. The customer who's interested in the special bracelet order would like special filigree applied to the bracelets. This filigree would require additional materials costing $2 per bracelet and would also require acquisition of a special tool costing $250 that would have no other use once the special order is completed. This order would have no effect on the company's regular sales, meaning there's capacity in the warehouse to accept this order should we go forward with it. The order could be fulfilled using the company's existing capacity without affecting any other order. So basically what's happening is this special order, they don't want to pay our normal price of $189.95. They only want to pay $169.95 times, how many did they want? 20. All right, so $169.95 times 20. If we accept this order, we'd get additional revenue of $3,399. Now, we'd still have to pay the $84 in materials. We'd still have to pay $45 in labor. Okay, but out of the $20 overhead, like we said, most of it was fixed, but only 4 of it was variable. So we'd only consider 4. In addition to that, we'd have this special filigree on top of that. So when we take our variable cost per unit and we allocate it among the 20, or we extrapolate it among 20 bracelets, here are the dollar costs. So revenue of $3,399 less a variable cost of $2,700, less we have to buy this one special tool for $250. Total cost of $2,950 is less than the actual revenue. So it's actually positive net income. If we wanted to accept it, we could. All right, so that is the analysis. We're only going to analyze if it will increase our contribution margin. If it increases our contribution margin, that means it's also going to increase our net income. And therefore, you would, of course, accept the offer. Should it be accepted? The answer is yes. Okay, so we have a company here, Outdoor Luggage, Inc. They make high-end hard-sided luggage for sports equipment. So they make a ski guard, a golf guard, and a fishing guard. Now, we see the details here. The selling price for a ski guard is $200. A golf guard is $300. A fishing guard is $255, less the variable cost per unit. That gives us our contribution margin per unit. So the ski guard, $140. The golf guard, $160. The fishing guard, $200. Now, all other things being equal, what should the company concentrate on? If the only consideration is contribution margin, well, which of the 3 is the highest? Well, it's the fishing guard, of course. That's the one I would concentrate on, all other things being equal. But you guys know the world is not equal. So the total time available on the plastic injection molding machine is a constraint, meaning we only have so many minutes on this machine, and we need this one machine to make all of them, the ski guard, the golf guard, and the fishing guard. So with that said, we need to determine which of these would be best to manufacture first, knowing that the constraint is minutes on the machine. Well, what we need to do now is not consider just the contribution margin, but we need to figure out the contribution margin per minute on the machine. So we have been told that a ski guard takes 2 minutes to make, a golf guard makes 5 minutes to make, and a fishing guard makes 4 minutes to make. Now that we know how many minutes it takes to make one, we can now take our contribution margin, as an example with the ski guard, 140 divided by 2 minutes, that's $70 a minute. The golf guard, 160 divided by 5, that's $32 a minute. And the fishing guard, 200 divided by 4, $50 a minute. Now with that additional information, we can see that, no, the fishing guard isn't where we want to concentrate. We want to concentrate on the ski guard, if indeed minutes on the machine is the constraint. So ski guard would be the answer. All right, now we're going to flip it a little bit. Now minutes on the machine is not the constraint. Now the constraint is the amount of plastic that's available to us. A severe shortage of plastic pellets has required the company to cut back its production so much that the plastic injection molding machine is no longer the bottleneck. Remember, a bottleneck is the constraint. Instead, the constraint is the total available pounds of plastic pellets. So once again, we still have our contribution margins. They don't change. 140 for the ski guard, 160 for the golf guard, 200 for the fishing guard. But now we need to consider how much is the contribution margin per pound of plastic. Remember, you always figure out what the contribution margin is per the constraint whenever we have one, so we can concentrate on how to best utilize that constraint. So a ski guard takes 7 pounds of plastic to make, a golf guard 4 pounds, and a fishing guard 8 pounds. So if we take our contribution margin divided by the 140 divided by 7 pounds, our contribution margin per pound of plastic is $20 per pound for the ski guard, the golf guard 160 divided by 4 or 40, and the fishing guard 200 divided by 8 or 25. So the answer would be golf guard if we have the constraint being the pounds of plastic. And the answer earlier was ski guard. All right, so even though the fishing guard has the largest contribution margin, based on the two constraints we talked about, we would never have chosen to work on fishing guards first. It would have been ski guard or golf guard depending on the constraint. So constraints, we figure out the contribution margin per the constraint. All right, next, we have a company, Portsmouth Company. They make fine colonial reproduction furniture. Upholstered furniture is one of its major product lines, and the bottleneck on this production line is time in the upholstery shop. So we actually don't have enough time in the shop to meet our customer demands. Upholstering is a craft that takes years of experience to master, and the demand for upholstered furniture far exceeds the company's capacity in the upholstering shop. So we have to find someone. We need a third party to help us. All right, now the bottom line is this. If we hire a third party, we want to make sure that we're not losing money. All right, if we're losing money, it doesn't make sense to utilize that third party. So the recliner sells for $1,400, and our variable cost per unit is $800. Sofa, $1,800 revenue, $1,200 variable cost, and the love seat, $1,500 revenue, less $1,000 variable cost. Okay, so the first question is, more time could be made available in the upholstery shop by asking the employees who work in the shop to work overtime, assuming that this extra time would be used to produce sofas. Up to how much of a premium should the company be willing to pay per hour? So sofas, we figured sofa was what? The selling price was $1,800. The variable cost was $1,200. That means that the contribution margin to make one sofa is $600. And if it takes 10 hours to make one sofa, 600 divided by 10, that means contribution margin per hour is $60. Well, that would be the absolute maximum that we would pay our employees. If we paid them more than $60, that means our expense is going to be higher than the contribution margin, and that doesn't make sense. So $60 per hour should be the absolute maximum. Now, how about number 2? A small nearby upholstering company has offered to upholster furniture for Portsmouth at a fixed charge of $45 per hour. The management of Portsmouth is confident that this upholstering company's work is high quality, and their craftsmen should be able to work about as quickly as Portsmouth's own craftsmen on the simpler upholstering jobs, such as the love seat. Should management accept this offer? Well, here's the analysis. Once again, we're going to figure out our contribution margin per unit, and we're going to divide it by the number of hours it takes to make one, and we figure out our contribution margin per hour. The recliner is $75 per hour. The sofa is $60 per hour, as we said earlier, and the love seat is $100 per hour. So if someone is offering to actually do the work for us for $45 per hour, we should accept it, because each of these three has a higher contribution margin per unit than the extra $45 per hour that we would need to pay in order to do the upholstery. So absolutely, it would be worth it. And the last one for the day. We have a company that can make a product and they can stop at a certain point, sell that product for a profit, or they can decide to process further. And if they process further, they would actually produce another product that would sell for a higher price. But of course, additionally, we'd have additional production costs. So we need to decide, should we sell or should we process further and sell the additional product? So the company's name is Dorsey Company. They manufacture 3 products from a common input in a joint processing operation. Joint processing costs up to the split-off point total $350,000 per quarter. The company allocates these costs to the joint products on the basis of their relative sales value at the split-off point. Unit selling prices and total output at the split-off point are as follows. Now remember what the split-off point is. The split-off point is the point where we can actually sell a product. All right, we've processed up to a certain point and we can sell a product if we wanted to. So what do we have here? Product A can sell for $16 per pound. Product B can sell for $8 a pound. And product C can sell for $25 per gallon. And here would be the output over here if we decided to sell these products right now. Well, bottom line is we can process each of these further. And if we did product A, instead of selling for $16 per pound, we'd be able to sell for $20 per pound. If we did so, we'd have additional processing costs of $63,000. Product B, $8 a pound is the selling price, but if we process further, we can sell for $13 each, and we'd have additional $80,000 in costs. And product C, we originally sell for $25 per gallon, but if we process further, we can sell for $32 a gallon, but we'd have additional processing costs of $36,000. So the question is, should we process further? Well, what you're going to do is you are going to compare the difference in selling price between selling or processing further. So for product A, it's the 20 less the 16, an additional $4 in sales. And the output is 15,000 pounds, 4 times 15,000. That's an extra $60,000 in revenue. But the author said we'd have additional processing cost of 63. Well, that's not worth it because the additional processing costs are more than the revenue we would bring in if we processed further. Product B, $13 selling price if we process further, less 8 at the split-off point. That's incremental revenue, additional revenue of 5 times 20,000 pounds. That's additional revenue of 100,000. And the additional processing cost would be 80. That's worth it. You can see we actually make money if we process further on that one. And product C, you can see the results. It would actually result in a loss if we process further. We'd have additional revenue of $7 per gallon times 4,000 gallons is our output. 7 times 4,000, additional revenue of 28,000, less the additional cost of 36,000. That's definitely not worth it. So product B in this example is the only one that is worth going further. All right, so product B was the one that we are going to process further.